Did you know that 90% of investors underperform the market over the long run? That's a shocking statistic, right? While everyone is chasing the next big stock tip or following trends, the true path to wealth is hidden in the quiet world of value investing. But here's the thing. Most people don't know about the books and strategies that could completely change the way they invest. What if I told you there are 6 secret books, not talked about by the financial elite, that hold the keys to understanding how to spot undervalued companies before anyone else does? These aren't your typical bestsellers. These books go deeper, uncovering strategies that could give you the edge and help you invest smarter than most pros. In this video, we'll dive into groundbreaking techniques that real experts don't want you to know. You'll learn how to spot opportunities hidden in plain sight, and how thinking differently about value investing can lead to massive returns. So stick with me, because by the end, you'll have a whole new approach to investing, one that could change your financial future forever. Ready to uncover the secrets? Let's dive in. Chapter 1. The Dark Horse of Value Investing, a hidden gem that changed my perspective. When most people think of value investing, names like Warren Buffett and Benjamin Graham come to mind. But what if I told you that the real secret to unlocking value is found in a lesser-known book? That book is The Little Book of Value Investing by Christopher H. Brown. The reason this book stands out is because it simplifies the value investing process while uncovering a unique strategy. Focus on investing in companies with strong management teams, not just undervalued stocks. Brown argues that investing in great businesses is more important than investing in cheap ones. His strategy revolves around finding companies that are run by people who are passionate, competent, and long-term oriented. This shifts the traditional mindset of buying low and selling high. Instead, it encourages us to look for companies that will grow steadily over time. A powerful quote from Brown: "The secret to successful investing is not finding the perfect company, but finding the right manager." This simple but profound statement shifts your focus from short-term market swings to long-term growth potential. One statistic Brown highlights is that the best-performing stocks in history didn't just have great numbers, they had great leaders. Companies like Johnson & Johnson and Coca-Cola didn't get to where they are by accident, they had visionary leaders at the helm. By focusing on management, Brown suggests you'll naturally identify companies that are primed for sustained success. In practice, this means digging deeper into a company's leadership track record. Look at how they've steered the ship through both good and bad times. If they've weathered recessions, market crashes, and technological changes, they are likely to be the kind of resilient business you want to invest in. The surprising part? Many people overlook the human element. They're so focused on numbers and ratios that they miss the real value. But, as Brown points out, it's the managers who steer the ship, not the numbers on a spreadsheet. Brown's book teaches us that the value of a company is more than just its balance sheet. It's about its ability to adapt, innovate, and grow in an ever-changing world. When you focus on these qualities, you find investments that can withstand time, not just market cycles. Chapter 2. The Contrarian Playbook. Why the experts missed the boat. If you want to stand out in the investing world, you need to go against the grain. That's the essence of The Dundo Investor by Manish Pabrai, a book that challenges traditional investing wisdom. Pabrai's approach is all about finding value in situations where others see risk. In fact, he calls his method the art of low-risk, high-return investing. Pabrai's strategy is built on one simple principle: the best opportunities often come during times of uncertainty. While everyone else is panicking, a contrarian investor steps in and buys when others are selling. Pabrai was inspired by the legendary investor, Charlie Munger, who once said, "It's not whether you're right or wrong that's important, but how much money you make when you're right and how much you lose when you're wrong." What sets Pabrai's approach apart is his focus on the Dundo principle, which means effortless wealth. He believes that by taking calculated risks, you can minimize the downside while maximizing the upside. He argues that when you invest in businesses that are undervalued or facing temporary challenges, you're betting on their recovery, without the need for significant effort. Here's an interesting statistic. Between 2000 and 2015, Pabrai's investment fund returned an average of 17.4% annually, nearly double the market average. This outperformance comes from focusing on simple but effective strategies, such as buying undervalued businesses and avoiding complexity. One unique fact Pabrai mentions is the concept of patience. He compares investing in undervalued companies to buying a distressed house. It takes time, but eventually, you can fix it up and watch its value grow. When you understand this, you'll realize that many great investments are just waiting to be discovered during periods of market panic. Pabrai's contrarian approach isn't just about being different, it's about finding value where others aren't looking. By focusing on businesses with strong fundamentals, good management, and a clear path to recovery, you can position yourself for significant gains when the market comes around to recognize that value. Chapter 3. The Unseen Influence: How Behavioral Economics Can Unlock Value in Misbehaving. The Making of Behavioral Economics. Richard Thaler explores how human behavior impacts financial markets in ways traditional economics often overlooks. Thaler's insights challenge the very foundation of value investing by demonstrating how psychological factors can influence market prices. He argues that investors often make irrational decisions, leading to stock prices that don't reflect a company's true value. One key concept Thaler introduces is mental accounting. This idea explains why people treat money differently depending on where it comes from. For example, an investor might sell a stock at a loss to cut their losses, but then turn around and buy another stock at a higher price, even if the new stock isn't a good deal. This irrational behavior can create market inefficiencies, which presents opportunities for value investors. Thaler's work suggests that by understanding human biases, such as overconfidence and loss aversion, you can identify stocks that are undervalued due to collective irrationality. He points to research showing that stocks tend to drop when companies announce bad news, even if the long-term prospects remain unchanged. This creates a buying opportunity for savvy investors. One study Thaler cites reveals that 90% of investors suffer from anchoring, where they base their decisions on irrelevant information. For instance, they may hesitate to buy a stock that has fallen in price, even if it is now a better value. By overcoming this bias, you can find opportunities others might miss. Thaler's research has practical applications for value investors. For example, when markets overreact to bad news or short-term challenges, investors who understand these biases can step in and scoop up undervalued stocks. In fact, Thaler believes that by recognizing these psychological traps, you can not only protect yourself from poor decisions but also uncover significant value in the market. So, how does this play out in practice? Think about the way stocks respond to short-term news, such as quarterly earnings reports or CEO changes. Often, investors overreact to these events, pushing prices down irrationally. If you can recognize when the market is overreacting, you're in a prime position to buy undervalued stocks at a discount. If you're finding these insights helpful, don't forget to hit the subscribe button so you can stay up to date with even more valuable investing strategies in the next chapters. Chapter 4. The Corporate Detective: Cracking the Code of Financial Statements. When it comes to value investing, the financial statements are like a treasure map. But how do you decode them effectively? In The Interpretation of Financial Statements, Benjamin Graham, the father of value investing, provides the tools to do just that. Graham stresses the importance of understanding a company's financial health, not just its stock price. One of the most powerful strategies Graham introduces is the concept of margin of safety. He explains that investing in a company with a strong financial foundation provides a cushion for unexpected risks. By focusing on companies with a low price-to-earnings (P/E) ratio and strong balance sheets, you increase your chances of a successful investment. Graham famously said, "The intelligent investor is a realist who sells to optimists and buys from pessimists." This quote highlights the importance of seeing beyond the surface. Financial statements offer clues about a company's true value, but investors often overlook these details in favor of more exciting trends. One of the key ratios Graham emphasizes is the current ratio. This simple calculation helps assess a company's ability to pay its short-term debts. A ratio above 1 means the company has more assets than liabilities, which is a sign of financial stability. Interestingly, a 2017 study from Harvard Business Review found that companies with higher current ratios outperform their peers over the long term. By focusing on this metric, investors can identify firms with solid foundations that are likely to thrive, even during market downturns. But Graham's focus on balance sheets doesn't stop there. He also emphasizes the importance of examining a company's earnings and debt levels. A business with high debt is more vulnerable to economic shifts, while one with steady earnings growth is more likely to sustain long-term success. By using Graham's strategies to analyze financial statements, investors can uncover opportunities that others may miss. The key is to look beyond the headlines and dig into the numbers, finding companies with a true margin of safety. Chapter 5. The Time Traveler's Guide to Value. How historical patterns predict the future. Want to know where the market is headed? Sometimes, the past can be the best guide. In Stocks for the Long Run, Jeremy J. Siegel takes us on a historical journey, showing that long-term investing is the key to success. He argues that despite short-term market fluctuations, stocks have consistently outperformed other forms of investment over extended periods. Siegel's research reveals a fascinating trend. Stocks have an average annual return of about 6–7% after inflation, stretching back more than 2 centuries. This long-term performance is a powerful reminder that the market rewards patience. Instead of trying to time the market, Siegel encourages investors to focus on companies with solid growth prospects. A compelling case Siegel makes is about the growth of dividends. He points out that reinvested dividends account for over 40% of stock market returns. By investing in dividend-paying companies, you're adding an additional layer of value. This makes Siegel's advice especially relevant for long-term investors looking to build wealth steadily over time. Siegel also highlights the historical performance of different asset classes. For example, stocks have outpaced bonds, real estate, and gold over the past 200 years. This historical data suggests that, despite all the noise in the short term, investing in equities remains one of the best ways to build wealth over the long haul. Another key idea Siegel introduces is the concept of market cycles. While markets go through cycles of booms and busts, history shows that they always recover. By investing in stocks during market dips and holding for the long term, you can ride the wave of recovery and achieve significant returns. But Siegel doesn't just focus on the past, he offers practical advice for navigating the future. He emphasizes the importance of diversification. By spreading your investments across different sectors and asset classes, you reduce the risk of significant losses during market downturns. In short, Siegel's work reinforces the idea that value investing is about staying patient, focusing on long-term growth, and letting history be your guide. His research shows that if you can withstand the market's short-term volatility, you'll likely be rewarded over time. Chapter 6. The Value Vault. Unlocking the secret strategies of old masters. The old masters of investing knew something that many of today's investors often overlook. In Common Stocks and Uncommon Profits, Philip Fisher reveals timeless strategies for identifying high-quality stocks that will stand the test of time. Fisher's approach is less about following trends and more about understanding the intrinsic value of a business. Fisher's strategy revolves around the concept of scuttlebutt, which involves doing deep research into a company's reputation and its prospects. He recommends talking to customers, competitors, and suppliers to gain insights that are not readily available in financial reports. This personal research, according to Fisher, is key to finding companies with long-term potential. One fascinating quote from Fisher is, "The stock market is filled with individuals who know the price of everything, but the value of nothing." This perfectly captures the essence of his philosophy. Fisher believes that investors should look beyond short-term price movements and focus on a company's long-term growth prospects. He also emphasizes the importance of evaluating a company's management. Fisher believes that the quality of a company's leaders is one of the most critical factors in determining its future success. A company with capable, forward-thinking leaders is more likely to thrive, even in tough economic conditions. Interestingly, Fisher's strategies have stood the test of time. In fact, his teachings influenced investors like Warren Buffett, who credits Fisher with helping shape his investment philosophy. Buffett has said, "I am a huge fan of Phil Fisher. His book, Common Stocks and Uncommon Profits, is one of the best investments I've ever made." Fisher also highlights the importance of identifying companies that are leaders in their industry. These companies have a competitive advantage, whether through innovation, brand loyalty, or economies of scale. Investing in such companies provides a greater chance for long-term success. A unique fact Fisher shares is that the best companies to invest in often have a unique product or service that cannot be easily replicated. By focusing on these types of businesses, you reduce the risk of market competition eroding their profits. Fisher's philosophy is simple yet effective. Focus on the long-term growth potential of a business, assess its management team, and invest in companies that offer unique value propositions. By following these principles, you'll be able to identify stocks with true value that will thrive over time, regardless of short-term market fluctuations. Thanks for watching. Be sure to hit that subscribe button to catch more in-depth value investing insights that will change the way you approach your financial future.